Good morning and welcome back to Almus Market Mornings. Our focus has firmly been on the ongoing Middle East war. I'm sure all of you have been following the updates. US and Israeli strikes killed the Iranian Supreme Leader, Ayatollah Khamenei. Since then, the war has spiraled. Missiles and drones have hit other countries like UAE, Kuwait, and now it seems Israel has started hitting Lebanon too because of the Hezbollah attacks. Things are getting messier. Oil prices have seen a spike to calm the markets. OPEC has agreed for an output hike, but broadly the situation is still evolving. Good morning, JK. Seems like our podcast on Friday was useful after all, considering the sudden escalation in the war. How are you seeing things play out from here?
Good morning, Suraj. So I can't recall a single Monday when we did not come back with some new development affecting the markets. And this has been, of course, this tops all of them in terms of its impact. And what I would like to say at the outset is that the situation is very fluid and evolving. And whatever updates we are passing on, our projections that we indicate are very much subject to changes, and hence actions should be directed more towards risk management. Uh, yeah, so the whatever happened over the weekend was not totally unexpected, but it was something unexpected in terms of timing, no doubt. So markets, I would say, not fully prepared. That is why we have seen some kind of a reaction, bigger reaction in some of the markets, and this is actually overshadowed a lot of big economic numbers that we have seen on the last week as well. Now, for example, the PPI inflation number came very hot on Friday in US, and that actually has put the rate cut expectations very much in doubt in even in June, but market has not really bothered about it. Then we had also the German inflation number, which came uh, below expectations, but does not change the ECB's expectation that they will stand pat on whatever the policies that they're keeping. And at the same time, even Japanese inflation was below previous month, and then of course it led to some higher than the expectations, but uh, does not really support the change in monetary policy immediately. But if you look at the overall picture, Japanese real interest rates are deeply in the negative. That's why the BOJ chief and other officials are hinting at monetary policy to normalize very soon. Now, all these things I'm just recapping because these are important indicators which would have normally moved the market, and that has not happened. In that direction, it has moved in the other direction because of the war event, which was very intense. And I mean, there was initially an expectation that since it has started in the weekend, by the time the new week starts, things will get somewhat settled, but then that has not been the case. And the retaliation from the Iranian side has also been quite intense, and at least going by their statements, it will intensify even further. And anything like attacking on the facilities of the US will only invite more actions from Israel or US. So that is the biggest risk for the market. The other biggest risk is the oil, of course, which supply chain disruption due to closure of Hormuz Strait. So far, some Iranian quarters have indicated that they are not looking to close that, but then there is a risk ships have stalled, and that's the reason why oil has also taken a big leap, almost 11% rise from where it closed on Friday. So the biggest indicator for the market perception of the risk is coming from the treasury bond yields in the US. Now, the treasury bonds in the US is now trading at 3.96. And looking at the PPI inflation number that came very hot, and also, this also actually indicates that the PC inflation number, which the US Fed tracks very closely, could be much hotter, closer towards 3%. So that normally you would have expected the treasury yield to move towards 4.30, where we are trading now. It is at 3.96%. That is the biggest indicator of how the market is perceiving the risk in the coming sessions. So that is where we are in terms of the market perception. And what we look ahead to is how long this conflict will proceed, and the intensity of the risk of trades. The extent to which the gold will rally, extent to which the oil will move, will depend purely on how it proceeds from here on. I think close watch on the headlines, and not just the statements, because now the statements are really misleading. As I said on Friday, we were hearing statements from the mediators as well as from the Iranian side that the talks were proceeding well, and it will continue. But what started on Saturday morning was a shocker. So I think the real action is what the market will be looking ahead to. Slightly medium term, the US actions in this year, be it Venezuela or in the Middle East, has also raised a very important concern for the market, that with such actions, unilateral action by the US, can you expect China, or Russia, to be restrained in whatever they pursue in geopolitical ambitions, like Ukraine peace effort? I'm not seeing that happening very soon. Russia's response unlikely to be very accommodative. Same is the case with China, where the Chinese-Taiwanese issue is still, a big question mark. What's going to happen? But it's not easy for US to protest against their ambitions when they had their US own actions or in this direction. So that is the medium-term challenge for the market, which means that we will be contending with many geopolitical issues through the year, and that's not going to go away from the traders' radar. Now, coming back to more specifics in the market, the you know, obviously the conflict has unsettled the investors quite a bit, and that's what is reflected in the safe haven trades that we have seen. As I said already, treasury yields have fallen, gold has rallied by over 1.5%, and there's no indication that these are reversing anytime soon, without real perception that things are getting better. So dollar could remain bid in this environment due to safe haven status, and it is also getting more support because it's already a bit oversold. So we can see the dollar index move towards 99, 99.20 from the current level of 97.60. Then we have, of course, the euro, which is also kind of have been bought quite a bit in the recent days, and that can lead to some retracement towards 1.17. Japanese yen is a big conundrum because the BOJ wants to normalize the policy, but there is a resistance from politicians for further hike in rates, and politicians even talk about pros and cons of a weak currency. So that's a big question mark as far as Japanese yen is concerned. And UK pound is also under pressure, not just because of the geopolitics, but also because of domestic politics as well. On the rupee, definitely a big challenge for the rupee, because the oil price hike not only brings in higher trade or current account deficit, but it also is probably going to add to the inflation. The inflation worry will definitely increase in all the regions, but for India also, of course, there is a lot of cushion because the overall inflation has been down. So oil imported inflation might just add to bring it to more towards RBI's median goal of 4%. But I think bigger worry will be if the oil sustains at above 80, and then supply chain disruptions continue to keep it higher as well. So the rupee, I think, which has been consolidating just under 91, thanks mainly due to RBI, will definitely break higher. But I think because of the one-way movement that we have seen in the USD INR for several months, and rupee being undervalued in RER basis, and also the seasonal factors in March, which generally favors flows, the rally in the USD INR could be not so big in the near term. So we could see more interest to sell also at higher levels, and not just from RBI, but perhaps from some exporters as well, now that the premiums are also higher. But I think it's not going to reverse the trend. The uptrend could be somewhat muted because of the seasonal factors and other positioning in the market as well. So yes, we keep our eyes and ears open and keep you updated as and when we see some developments with the impact on the markets. Thank you.
Thank you, Jackie. And as you mentioned, the situation remains quite fluid. Things are evolving quite quickly. But as far as what we know as of now, it seems that going by the Iranian statements, there will be more retaliation. And of course, there's a risk of the Strait of Hormuz closure because that risk is very significant because 20% of the global oil supply passes through that region. And any spike up or any sort of closure of that strait will be quite significant for the global supply chain of oil. Overall, we are seeing safe haven demand. Dollar is being paid, treasury bonds being bought, and of course, gold being rallying. Gold has rallied quite significantly. Euro pound remain under pressure, and even for rupee, this is a challenging time considering that oil prices is a big negative. We are one of the second largest consumers of oil, and we are heavily dependent, import dependent. We are a very price sensitive country, and that will weigh on the rupee. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.